this is going to be a complete change. I mean, it really is so simple. This is the end of this current fiat money experiment.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Lynette Zang. She's the chief market analyst at ITM Trading. And according to her, she's been in the space since 1964, when she found her uncle's safe, I think. And she also started on Wall Street in the mid 80s, I think, or 1987. So
86.
Yeah, 86. So she's seen everything, and she also started looking at currencies and its cycles. And we spoke about 3 months ago, and I thought it would be good to speak to Lynette again and see what's going on, Lynette.
Oh my God, what isn't going on right now? You have so much that's happening as we make this transition. Doesn't it kind of feel like we just go from crisis to crisis to crisis to crisis, keeping everybody off balance?
That's right. And one thing I wanted to talk about that I saw you spoke about a couple of weeks ago is the FDIC. And from what I remember well, the FDIC used to just insure deposits for bank deposits. But a few years ago, still in the Obama administration, they snuck in something in the National Defense Authorization Act at the end of the year that the FDIC would also cover the big banks' derivatives. So maybe you could touch upon that.
Well, personally, I think it's absolutely impossible to cover all of the derivatives because we don't even really know the level that is at risk. And a derivative is derived from an asset. And it could be a stock or a bond or an interest rate or the weather. I mean, it's derived from anything. And that's the way banks generate almost, well, actually more than 50% of their revenue anymore is derivative trading using your equity, partly your deposits, as collateral for their trading activity. So, you know, we're only covered, and really, first of all, the whole world has a deposit insurance scheme, and they call it a scheme. I'll agree with them, but I didn't coin that term. They actually say that it's a scheme. And they started that scheme to generate confidence in the banking system. But what we've observed, especially since 2013 with Cyprus, is that, you know, every scheme fails ultimately when all confidence is lost. And so how can you cover the derivatives? I mean, these are being and can be used as weapons of mass destruction. And I think that's ultimately going to be our undoing because there isn't enough new money in the world, really, regardless of how much they print. There's just not enough to cover all of these big bets, especially when nobody really knows how big this really is.
Yes, and the BIS says there's around 630 trillion, but I think they changed the method of accounting for them after the '08 crisis. None of the derivatives were abolished or regulated, and still, like you said, it's really difficult to know how much there is. I think the BIS even said a few months ago that there's 80 trillion that they didn't know about in the shadow banking system.
Right.
Yeah. So, yeah, I think in the UK as well, we have something called the FSCS, and they're covered or funded by the banks, probably just like in the US, the FDIC.
Exactly.
But the assets they have would never cover the whole if there was a systemic crisis. And like you said, they could go with the printing bazooka, but it would just destroy the currency if they'd have to save the banks. And I wanted to also touch upon, if possible, Lynette, the subject of the dollar's loss of reserve currency status, and how that will affect Americans, but also people here in the UK, because the pound is a derivative of the dollar, I would say.
Right. And I mean, that's true for all of the currencies since the 1940s, where they've been tied to the dollar. And the dollar has really enjoyed massive benefits by being the world reserve currency, because it created an artificial market for dollars. But no currency has ever withstood the test of time in as far as the world, well, actually any fiat currency, any government-based currency. And this time is not any different. And even though, I mean, I think what's interesting, Mario, is that things always go really slow until they go fast. And so the time to be prepared is well before that. But it was already in 2002 where the Federal Reserve started buying back U.S. government treasury debt. And, so that was already a period where we were not attracting enough foreign investors of our debt. We had to have the Federal Reserve step in. But did anybody talk about that? Heck no, because they don't want you to know. And so it makes me nervous when there's any topic that, frankly, they're not really talking about. But for people in the U.S., what that means is all of those excess dollars, especially with Saudi Arabia saying, hey, we'll accept any currencies for our oil. Well, we retained that status because of the petrodollar, where countries had to use dollars to buy oil. As that shifts, though, they don't have to. So the U.S. will pay for that privilege in a rather big way when all those dollars start to come home. And, if they're trying to tell us that inflation is cooling off, yeah, I think that headline inflation is because oil dropped from 120 to 80 something. However, that's not going to be maintained. And I think that you will definitely see a ratcheting up of inflation. Plus, we haven't even felt the impact on a global basis, let alone on a local basis, of all of the central bank tightening, because it takes a certain period of time, usually 12 to 18 months, to work through the system before they can see if they got what they wanted. And so we're not there yet. And I have a really sneaking feeling that, and sinking feeling as well, that when the impact of the choices that the global central bankers have made actually impacts the global economy, well, Wall Street's definitely going to be singing a very different tune. But, I think it's going to exacerbate the retirement crisis that we're in the middle of, that people don't realize. I think a lot of things are going to come up that people right now don't see, and I kind of have a question for you. And that is, everybody always assumes that central bankers and governments want this to just keep going on status quo. But when you look at the value, the purchasing power value of currencies, and the fact that, interest rates were anchored forever at zero after the 2008 financial crisis, which I still maintain is when the system died, maybe they don't really want it to be status quo, right? Maybe they want to push us and what they would call nudge us into a crisis so that they can execute the next part of their strategy, which is taking us into a full surveillance central bank digital currency.
There's quite a bit of debate about that, whether this is being engineered on purpose, or it's just their incompetence. And I have to say, it's difficult to say, but whatever happens, I think having gold and silver outside the system is a good way to protect yourself. Yeah. I mean, I actually think it's a bit of incompetence, but maybe the people really at the top that we don't even know about that have been behind academia and the system for generations, and it can be uh, passed on through generations. They've done this on purpose, and people like Andrew Bailey and Jay Powell and Lagarde, they look like buffoons because they thought 18 months ago that it was going to be temporary or transitory, the inflation. Now everyone is come out and they're saying, the same people that said it was transitory, they're saying, oh, we've peaked in inflation. Now it's going to go down. And we know that inflation comes in cycles, like the inflation in the 70s and 80s started actually in the mid 60s with the Vietnam War and all the spending on the Great Society program. So yeah, I think it's a mixture of both. And yes, I do think they want to like enslave us even more, take us away from real money. I mean, they did that when we left the gold standard. In the US, it was 33 domestically, and in Europe in 1914. And we haven't had that link to real money since then. And now they want to take the link away from the paper money that represented the gold and put us in this digital prison. So I agree with you, and I think we need to keep exposing that. Yeah, so that's my answer to your question. And before we go further, just wanted to ask you if you could tell the viewers how ITM Trading has this wealth shield that's supposed to help people in these turbulent monetary and economic times.
Yeah, well, the wealth shield is based upon repeatable patterns. And it's really designed. I mean, I've been studying currency and currency life cycle since '87. And when you look at them, I mean, you've got over 4,800 examples, even a recent example in the Lebanese pound. But when you look at those patterns, they're repeatable. So the wealth shield is designed to maintain your current standard of living by ensuring that you have enough barterable wealth to actually buy the things that you want and what that you need when nobody will accept this in any form, whether it's physical or digital. It's also designed to protect any wealth that you have accumulated so far that you can't take out of the system or you choose not to take out of the system. Right. So you want to make sure that you have a truly diversified portfolio, and certainly physical gold and physical silver do that. And then it's also set up to, depending upon your goals. I mean, really, we define your goals first. That's where everything starts. But for example, for me, where I have children and grandchildren, that for me, I want to do something like the Queen of England did. In other words, ensuring a legacy for my children, because the world that they have mapped out for us, and we have a chance of not being forced into it, but in that new world, you will own nothing and be happy. We're going back to feudal times because wealth never disappears. It merely shifts location. So leaving a legacy so that my children, my grandchildren, my great-grandchildren, et cetera, on and on through the generations actually have choices because they're actually holding their purchasing power or wealth is critically important. So we cover all of that in the Wealth Shield, and it's simply based on repeatable patterns. So it's not rocket science. It's not really that hard to understand. A lot of my work is about those patterns. War is one of those patterns that occur every time there is a currency regime shift. And I think we're definitely headed to a global hyperinflation because this is all they have is the printing press and interest rates. And all global central banks are in a huge conundrum. So that's what the Wealth Shield does. And it always has to start with your goals and your circumstance. So your strategy will be similar to mine, but tweaked based on my personal goals and my circumstances. Yours will be tweaked on yours.
So it seems like a generational wealth building exercise or preservation, and I think that's good because nowadays a lot of people just want to know. And I mean, we're all like a little bit victim to the fluctuations of the paper price of gold and silver, but the way you speak about it, it's more about the future, and I think that's a good thing. The other thing I wanted to touch upon, seeing that we have a couple of people speaking today. I think Jay Powell's speaking in about 30 minutes, and then we have the president giving his State of the Union address. Just wanted to see what you think about the U.S. debt ceiling. I think the other day or yesterday, the CEO of Bank of America and even Janet Yellen said that it could lead to a major global financial crisis. And for once, I agree with Janet Yellen. So what's your view on that?
Well, the debt ceiling, you always hear them come out, well, that's not about new spending. That's about the spending we already did. And you might remember that 2011, there was this huge battle and the US actually lost its AAA rating. So if we're going into another huge battle, not only could we lose another rating or more, do I think we're going to not raise the debt ceiling? No, I think we're going to raise the debt ceiling, of course. But what we don't know is how much friction and, is it going to happen at the 8th hour? Because we're already under extraordinary circumstances. So I feel like there are lots of games of chicken being played between Republicans and Democrats, which, I don't really know that there's that much difference, to be honest with you. So I think it's just more of a distraction between the markets and the central banks. They gave up that forward guidance in August, which shocked the Hades out of me when they did that, because that's such a key tool. And it's hard to get that credibility back. So, yeah, I think the debt ceiling, and they don't understand inflation. They admitted it. They don't understand it. Yay. That's who we want guiding us through this mess. I mean, Lagarde said it. Powell said it. They created this monster, and this monster will unfortunately eat everybody alive.
Yeah, I remember, I think it was in April 2021, Jay Powell was asked in Congress about inflation. One congressman or woman, I don't remember, said, you've printed so much money in reserves after COVID. Won't that create inflation or rising prices with all this new money supply? And he said, no, money supply has nothing to do with inflation. So yeah, it's really worrying. And I noticed you said that the credit rating, of course, was I think it was Standard & Poor's. They lowered the credit rating in 2011, and actually, the CEO at the time, he lost his job, not surprisingly. So I'm not sure they'll cut the rating again of the U.S. But could it also accelerate the move from China and other the BRICS countries or the global South into focusing on their new system, seeing that you have to depend on this kind of brinksmanship and crisis every few years for something that you have to hold as reserve?
I would, I would definitely agree with that, but I think that that's, again, been a long time in coming, where they have created an alternative to the US dollar SWIFT system that was weaponized and is being weaponized, and, basically showing our hand that you do what we want or we will punish you. So yes, I think that is coming. And now, do I think that that's going to be the world reserve currency? No, my bet is still on the SDR as a basket of currencies, so you can have a local currency, and then people don't realize that anything changed, like the digital dollar, right? It'll still be called the dollar. But I think the SDR is a basket of currencies that they could easily vote to expand to include every currency is the most logical new world reserve currency to me, simply because everybody's got some. They've got lots of them now because they keep creating these. They keep creating more and giving them away to all of their members. And so it's been around since '69. Everybody's got a lot of them. They don't need to necessarily reinvent the wheel. But I do think that, here's the thing, Mario. With us poking the bear, meaning Russia, China, North Korea, are we headed into World War III I keep going back to that because so many of the moves that I see these central bankers and these governments make look like they are shifting into the next collapse. And even for Powell to say, well, all of that money creation didn't create inflation. Yeah, it did. It created real estate, stock, and bond bubbles. And therefore, going back to the first thing we started talking about, derivative bubbles. And we've got this transition coming up on June 30th that, are you hearing a lot of talk about it where you are? Because we're not hearing very much talk about it here. It's really quiet.
Oh, the Libor phase out. No,
Yeah.
I'm not hearing much here in the mainstream media. I follow the FT, the Telegraph, but what I've been hearing is people commenting, my viewers about it. And actually, I wanted to ask you about that because the phase out has been really tough because Libor is just like a reference that bankers use to ride a lot of these derivatives and to ride a lot of mortgages and loans. So it could create a problem. And like I said, I haven't heard much about it, but they might have a huge crisis or distraction, and then they'll just kick the can down the road again, and the BIS will say,
Can they?
"Oh, I don't know if they can."
They phased out your ability to embed Libor in contracts, and they had to force it in January of 2022. They forced it. So, I don't know if they have the ability or if they've just backed themselves into a corner. And for me, it's really troubling that they're not talking about the progress. What has been coming up is that owners of CLO, collateralized loan obligations, which is basically the new CDO, according to the Bank for International Settlements, collateralized debt obligations, but the CLOs are starting to push back on the transition because the new reference rate here, and I'm sure I don't know that this is true for all the reference rates. You're going to know it more for Great Britain. But the SOFR that we came up with in the US, that even using another mathematical formula to get it closer, does not match the Libor. Does not match it. So it may be seemingly only pennies, except when you put trillions together, you're talking about a lot. And in some cases, like with the CLOs, there are some cases of those that have to transition where everyone has to agree. And we're seeing some disagreements. I don't know what that means because nobody is talking about it, but that fact alone has me rather bothered because when they ran the test in October 2019, it was a big fat fail. And then they came out and kicked the can down the road to 2023. Or was that 2020? It was October one of those years.
Yeah. Do you think in 2019, that's what triggered could have been what triggered that repo crisis, I would say.
Well, it was the lack of liquidity,
Yeah, yeah.
right? I mean, that's really what all of this is about, because our whole system is based on the ability to print more money and create more debt. And so, we've been having liquidity issues, particularly the one that's scariest, really, are issues around treasury bonds since 2015.
Yeah, and they've been looking at it as well since 2020 at the liquidity in treasuries. And I mean, liquidity is like the difference between the bid and offer, and treasuries are supposed to be the risk-free and the most liquid market in the world. And you can drive a bus through the bid and offer right now, and that's troubling. And it could be to do with Libor. The thing is, like you said, this market is so opaque and so unregulated. I'm sure the bankers know what's going on, and maybe that's why Jamie Dimon said last year that we need to prepare for a huge storm coming.
And just to add to that,
yeah,
maybe that's why in this recent meeting, I think it was November 6th, of the FDIC body that actually manages the dissolutions of the bank, where they made the statement. I mean, do they not think that these things are being videoed? It's amazing to me when you listen to them. But they're sitting there saying, well, everybody, look, there's lots of attorneys and accountants out here for those that really need to understand what's going on, but we don't want the public to understand what's going on. And the fact that, this is not a quote because I'm all discombobulated on it, but the fact that they should know that they're going to be bailed in, because they are going to be bailed in, meaning they are going to take depositors' money and leave them shares of stock in the failing institution. And they admit that openly. So, these things are hidden, to your point. Those that need to know, those that have been chosen to be too big to fail, the winners of this whole mess, they know what's going on, and they are getting into position to weather the storm. It's just the normal person that's out there that has the sticky relationship with their bank, meaning you don't change bank accounts all that often. Typically once you get one, you just kind of keep it forever. So they know that. So the depositors are sticky money, and that's just about the right size to be bailed in.
Yeah, it's really hard to change your bank account because you have all the direct debits, all the stuff set up. And
Yep.
here in the UK, the Libor change, that has been done. It's the Sonia. So I don't think they've had a problem with it. But that's for sterling offered rates.
Is it completed?
Yeah, I think it's pretty well completed. They've gone away from, because Libor could be used for dollars, sterling, euros, all different currencies. The dollar is called euro dollar, outside dollars outside the system, outside the US, I'm sorry. And even sterling trading outside the UK used to be called euro sterling, but the Sonia has been completed, but it's I would say it's not that relevant. The relevant and most important one is the US dollar Libor, because it's such a huge market, and it doesn't just affect the United States, it affects the whole world because there's so many dollars sloshing around the system.
But the latest that I saw from the Bank for International Settlements, so it could be less now, I don't know, that there was still 610 trillion in notional value derivatives that still needed to convert into the new benchmark. So I didn't see where they were specific to country. They just made that broad statement. So that's globally.
I would say, though, that the bulk of the derivatives that the BIS looks at is in US dollars. That's a huge number, 600 trillion still, and that would be a problem. talking about the State of the Union, I've heard recently, I think it was Yellen, the Secretary of the Treasury, say that, well, the economy is doing great because unemployment rate is the lowest in 53 years. But my question would be, Lynette, if that is so, how come the federal government isn't rolling in tax receipts and running a huge surplus and paying down the debt? Well, you've got like a debt ceiling crisis. So,
Right.
yeah, so I wanted to see what you think about the yield curve and what it's really telling us about the U.S. economy.
Well, first of all, historically, 100% of the time when that happened, there has been a recession. This will be far more than a recession. But even more troubling is that the global yield curve has inverted. I think that happened in November, December, something like that. And that's the first time that since they've been tracking it, that has ever happened. So even back during the Depression in the 30s, honestly, it was a global depression and we weren't so interconnected as we are now. So if we had a global depression, what does that mean for coming up? This is going to be a complete change. I mean, it really is so simple. This is the end of this current fiat money experiment based upon debt. They have to burn off this debt, and so hyperinflation is the way that evolved and advanced economies settle that debt in currencies that have virtually no value. And, that's true with all currencies. So, that's why you've got to have physical gold and physical silver, because governments, what they can do, and we just saw this with the Lebanese pound, right? They suppress the price of gold because gold is good money. So a rising gold price is an indication of a failing currency. So it's kind of like a spring that you hold in your hand. And then when you remove your hand, the spring shoots in a direction. I think it was up over 1,500% overnight in that first overnight revaluation in the Lebanese pound. So don't be fooled by the prices that Wall Street is showing you. Those are the nominal prices and do not reflect the true value. They merely reflect the wishes and the whims of those that are in power and wanting to stay in power and they're accumulating it. I mean, look at the drawdown on the COMEX and the LBMA. That's big, smart money. Look at the fact that central banks are buying more gold than 1967, which was when we were transitioning into the new system, right? And people will refer back to the 60s, the 70s, the 80s, the 30s, the 40s, and they never take that next step. What was happening then? We were transitioning into new monetary systems. So you can stay vulnerable, that's your choice. But personally, I don't own any fiat money products more than some cash that I got to have because that's your first line of defense. And, like you made mention of before, debits come out of it. I'm running a business, so I got to make sure I can pay payroll. But other than that, why would I? Because I know the truth. This is what I own, gold and silver, physical and in my possession, that runs no counterparty risk. Biz says only financial asset that runs no counterparty risk. Everything else is credit. It's all debt and it's all counterparty risk.
Yeah, I spoke to a guy from Beirut about a year and a half ago, and he was telling me about what happened in Lebanon, and it's very similar to if you compare the price of gold in dollars to the price of their currency in dollars, the Lebanese pounds. It was very stable and fixed for like almost 20 years. And so people actually thought that they had the dollars in the bank. And when it all blew up in, I think, late 2019,
Mhm.
the banks basically stole all those dollars and shut the banks and said you can only have $100, or you can have Lebanese pounds but not dollars. So I think they've done the same thing to Americans and people in the West. People that think they have gold, a lot of them, they buy ETFs, and they think the price is never going to go up, but then one day everything blows up, and and you go ask GLD or another ETF for your gold, and they'll say, "Oh, sorry, you haven't got it. You can have dollars," and then gold is a lot higher. So yeah, the lesson in Lebanon, and I think in Argentina they had something like that called the Corralito. Citibank said the government in Argentina told Citibank not to pay their depositors their dollars. They just basically stole it. So that's why you have to have it physically, because there's no counterparty risk. So Lynette, any last words for the viewers and where they can find your analysis on social media?
Oh, absolutely. I mean, we are on YouTube, ITM Trading .com, and or you can even Google my name. You can search my name rather, Lynette Zang. We also have a Twitter account, ITM Trading _Zang, and please be careful with that because I know we get mimicked a lot, but it is ITM Trading _Zang. Instagram, Lynette Zang. Facebook, Lynette A. Zang. And we do a podcast, so Spotify, Apple, Google, all of the major platforms. And because you need more than gold and silver, we have another YouTube channel that we started called Beyond Gold and Silver, and it talks about my mantra. So food, water, energy, security, barterability, wealth preservation, community, and shelter, because these are the things that we all need to sustain a reasonable standard of living. And, you know, we want to help you wherever you are. That's where we want to be. So if you're new to all of this, great. We've got some basic education to get you started. If you're an expert, come help us spread the word.
Yes, and I tell my viewers as well, for those who don't know, I have partnered with ITM. So if you want to know the details of how to get in touch with them, to go in the description of this video. And Lynette, thank you very much. I look forward to coming on your channel as well.
Yeah, I know you're already scheduled. I look forward to it too. Then I get to ask you questions.